What if I told you there's a single powerful investing secret that allows you to buy anything you want, secure your retirement, and even thrive during economic chaos? Imagine a life where financial stress is a distant memory, where every purchase is effortless, and your loved one's future is undeniably bright. This isn't a fantasy. You're about to discover a game-changing philosophy from Nick Maggiulli's influential book, Keep Buying, a simple yet profound approach that will reshape how you think about wealth, growth, and securing your financial future. This isn't just about saving. It's about mastering the art of consistent, strategic investment. You'll learn where to put your money, how to handle the inevitable ups and downs of the market, and what to do when crises hit. Because when done right, investing isn't a temporary strategy, it's a daily habit that can last a lifetime and lead to extraordinary results. What does keep buying mean? So what exactly does keep buying mean? It expresses a simple yet incredibly powerful philosophy. Continuously invest in a diversified portfolio, regardless of what the market is doing. Whether prices are soaring or crashing, whether the economy is booming or struggling, the key is to never stop. Just as you regularly pay your rent or grocery bills, investing should become an essential, non-negotiable part of your routine. This approach doesn't demand perfect timing or insider knowledge. All it requires is unwavering discipline and commitment. And in our modern era, it's easier than ever before. Thanks to digital platforms offering free trading, low-cost index funds, and diverse investment opportunities, you can own a piece of the world's largest companies with just a click. Don't let fear or confusion hold you back. As you'll discover, the investing process is simpler than you might think, and far more rewarding than you can imagine. Let's begin this journey toward financial growth and building long-term wealth. A day will inevitably come when you won't be able to work, or perhaps you simply won't want to. By investing now, you build a stable income stream that supports you long after your working years end. This is the bedrock of financial independence, allowing you to live with dignity and confidence in old age. It might feel difficult to picture yourself in your 60s, 70s, or 80s, especially if you feel active and energetic now. But science tells us that thinking about the distant future significantly impacts our current financial decisions. In one fascinating experiment, people were shown digital images of how they would look decades later. The result? Those who saw their future selves invested 2% more in their retirement pensions compared to those who didn't. Just seeing their older selves made them take saving and investing far more seriously. But wait, the scientific evidence behind this is truly fascinating. Another study asked participants their reasons for saving money. Researchers found that those whose stated goal was retirement or emergencies were more committed to long-term saving compared to those saving for short-term goals like a new house or a trip. Investing isn't selfish. It's smart and responsible. When you invest for your future, you're not just thinking of yourself. You're taking a vital step to protect yourself from relying on others later, planning to be a source of support for yourself when you need it most. So don't wait until it's too late. Start now and build a secure financial future that supports you throughout your entire life. Second, protect your money from inflation. Inflation is like an invisible tax, slowly but steadily eroding the value of your money over time. Whether it's the cost of food, education, transportation, or housing, prices are constantly on the rise, even if your income remains the same. In the short term, inflation might not seem like a major threat, but over the long term, its impact can be devastating. For example, if the annual inflation rate is just 2%, you will lose half of your money's purchasing power within 35 years. And if inflation jumps to 5%, that same decrease in value happens in just 14 years. The higher the inflation, the less your money can buy of the same goods and services. And here's why ignoring it is costing you more than you think. So how do you combat this insidious challenge? The answer is investing. By putting your money into assets that grow in value over time, you can outpace inflation and preserve your purchasing power. Consider this: $1 invested in long-term U.S. Treasury bonds since 1926 grew to nearly $200 by the end of 2020. But if you invested that same dollar in a diversified portfolio of U.S. stocks, its value would have exceeded $10,000 in the same period. That's the staggering power of long-term investing. Imagine being retired without a salary while living costs continue to climb. If you had invested throughout your life, you would have a stable, passive income stream that supports your lifestyle. Third, convert human capital into financial capital. Your human capital is the value of your time, knowledge, and skills. While you can always develop your skills and increase your knowledge, there's one thing you cannot increase: your time. As you age, your physical and mental energy will naturally decline. You won't be able to work with the same efficiency you do today. Therefore, it's incredibly wise to convert a portion of your income during your working years into investments that continue to work on your behalf, even when you can't. But there's a way to make your money work harder than you ever could. Let's say you earn $55,000 annually over the next 40 years, consistently saving 15% of your income while achieving an annual return of 6%. Over time, you won't just save enough to cover your needs. Your wealth will grow even faster, thanks to the magic of compound interest. Even after retirement, your investments will continue to generate income for you. If you start investing today, you can enjoy a peaceful retirement tomorrow. You won't need to worry about medical bills, securing your children's future, or covering daily living expenses. Even as you enjoy time with your family and loved ones, your money will continue to work for you, granting you the financial freedom you truly deserve. What should you invest in? Okay, you're convinced you need to invest. But where do you even begin? Perhaps you've watched experts on YouTube or read books promising the ideal path to wealth. But the truth is, there's no single path that works for everyone. Everyone has different goals and different financial circumstances. So it's crucial to study the available options and choose what suits your personal needs. Ultimately, your goal is to build a diversified investment portfolio that contains assets generating continuous income. This is the core message of Keep Buying. Invest regularly in a variety of assets over the long term to achieve steady growth. So, what types of investments can you consider? Let's explore some key asset classes that can help you build wealth. We'll look at their benefits, risks, and how to invest in them. But remember, before making any decision, make sure you understand each option well. First, stocks. When you buy stocks, you become an owner of a part of a company. Historically, stocks are considered one of the most effective ways to build long-term wealth. Researchers studied stock market returns in 16 countries between 1900 and 2006. Despite major events like 2 world wars and the Great Depression, all these countries achieved positive long-term returns. For example, Sweden achieved an average annual return of 8%. The United States came in at 6%, and even Belgium, which was the lowest. One huge advantage of investing in stocks is that it doesn't require daily maintenance. Once you buy them, you can leave them to work on your behalf, continuing to generate returns. Stocks do have a downside: volatility. Historically, stock prices have fallen by approximately 50%, twice every 100 years, by 30% every 4 years, and by about 10% approximately every 2 years. These fluctuations can be a particular psychological challenge, especially for new investors. But here's the crucial insight that separates winning investors from the rest. However, the key is to focus on the long term. Historical data consistently indicates that financial markets always recover from crises and continue to grow. Second, bonds. When you buy a bond, you are essentially lending money to a government or a company for a specified period. In return, they pay you interest periodically until the maturity date, at which point your principal capital is returned. A bond's yield is calculated by dividing the annual coupon value by the bond's purchase price. For example, if you bought a bond for $1,000 and received annual interest of $100, the yield is 10%. There are several types of bonds, including municipal bonds, loans to local governments, corporate bonds, loans to companies, and foreign government bonds issued by other countries. Foreign bonds usually offer higher interest rates, but carry greater risks because other governments or companies might not be able to repay their debts, especially during difficult times. Unlike the U.S. government, which can print money to pay its debts if necessary. Why choose bonds? Since bond returns are often lower than stock returns, they primarily serve as a means of risk reduction. Bonds provide stable returns and are generally less affected by market fluctuations than stocks. adding bonds to your portfolio gives you balance. Even when riskier assets like stocks decline in value, bonds offer stable returns. They are also considered a good source of liquidity. For example, if the stock market crashes and you lose your job, you can sell bonds without incurring significant losses. You can buy bonds directly, but the author recommends investing in bond index funds to achieve diversification easily and reduce risks. Third, real estate. Investing in real estate can be a powerful tool for building wealth. You can achieve regular income through renting properties while also benefiting from their long-term appreciation in value. Using leverage is common. If you buy a property with a loan, you're using leverage. For example, with only $100,000, you could buy a $500,000 property by borrowing $400,000. If the property's value increases to $600,000, you can sell it, pay off the loan, and still have $200,000 in profit, effectively doubling your original investment. But leverage can be a double-edged sword. If the property's value drops to $400,000 and you sell it, you would lose your initial investment of $100,000. Fortunately, significant crashes in real estate prices are rare, and their value usually increases over time. For this reason, many investors successfully use leverage to their advantage. However, this seemingly lucrative path comes with its own set of challenges you need to understand. The downside: as a property owner, you will need to manage tenants, perform regular maintenance, and you might have to deal with platforms like Airbnb. While real estate can offer higher returns than stocks or bonds, it requires significantly more effort and time. Furthermore, real estate is an undiversified investment, meaning you expose yourself to concentrated risks. If the property faces problems, or if a crisis occurs, like the COVID-19 pandemic, you could incur significant losses. If you are looking for more control and tangible ownership, real estate might be a suitable option for you. Just make sure to research thoroughly, consult experts, and be prepared for technical and legal complexities. Fourth, real estate investment trusts, REITs. REITs allow you to invest in real estate without the need to manage properties yourself. These are companies that own and operate income-generating properties. As an investor, you earn profits from these companies' earnings. By law, REITs must distribute 90% of their income as dividends to investors, making them a good source of regular income. Types of REITs include residential, apartments, single-family homes, student housing, and commercial, office buildings, retail spaces, warehouses. REITs can be publicly traded or privately non-traded. The author recommends investing in specific REIT index funds to achieve broader diversification and reduce risks. While REITs perform well in stable times, they can decline sharply during crises. They are considered a risky tool rather than a true means of risk reduction. Why shouldn't you buy individual stocks? Now, this might surprise you, given all the buzz around hot stocks and expert picks. But there are two main reasons you should avoid investing in individual stocks. One is purely numerical, and the other is existential. Let's start with the financial argument. Even the best professional investors in the world, those with huge teams of analysts and advanced research tools, face immense difficulty outperforming broad market index funds like the S&P 500. These funds are backed by professional teams and vast resources, yet they still struggle. If professionals can't consistently pick winning stocks, it's highly unlikely that ordinary investors will achieve better results. The data on this is absolutely brutal for individual stock pickers. Research also reveals that only a very small percentage of individual stocks achieve good between 1990 and 2016. Only 4% of U.S. stocks were responsible for all positive market performance compared to Treasury bills. This means that a staggering 96% of stocks either failed or did not generate any valuable returns. Ask yourself, what are the odds of you picking a stock from the winning 4% instead of the losing 96%? To illustrate further, look at the Dow Jones Industrial Average in March 1920. None of the 10 companies that were part of the index then are still in it today. Even the largest, most successful companies don't stay on top forever. Picking the right stock is much harder than it seems. Beating the market is a rare feat, even for the most skilled investors. The chances are slim, and the risks are high. For this reason, investing in low-cost index funds or REIT index funds is a smarter choice. Not only does it reduce your stress, but it also index funds spread your risk across hundreds of companies, providing stability and consistent returns over time. But beyond the numbers, there's a deeper, more personal challenge: the existential argument. This point relates to your confidence and your abilities as an investor. How can you truly be sure you are good at picking individual stocks? Can a single successful trade made over a day, a week, or even a year prove that you are a skilled investor? Probably not. In fact, it might take years to know if your decision was based on skill or just sheer luck. And even then, you have to compare your results with an index like the S&P 500 to see if you are truly better than it. And here comes the biggest challenge. What if your good performance wasn't because of your personal analysis, but due to factors beyond your control? Imagine a stock you picked rose significantly, not because you saw something others didn't, but because it became popular on social media. Can that truly be considered skill? Let's assume you are a professional fund manager. Studies show that even professionals tend to lag behind their benchmark performance over a 3-year period. When that happens, they start to question, was it just a difficult period? Or have they lost their skills forever? This isn't just about money. It's about your sanity and long-term peace of mind. This is the investor's existential anxiety. It's mentally exhausting, and emotionally draining. Analyzing individual stocks, monitoring the market, and constantly evaluating returns can become a full-time, stressful job. Even worse, a single drop in stock price can wipe out a significant portion of your investment in a matter of hours. But does the market need stock picking? Of course. There is a need for those who pick stocks, analyze them, and actively invest. These individuals help set prices and keep markets efficient. But for most ordinary investors, there is a better way. Investing in index funds and REIT index funds. This way, you can avoid unnecessary stress and significantly reduce the risk of losing your hard-earned money. You don't need to guess which stocks will win. Simply keep buying a portion of the entire market. This is not only a safer strategy, it's also smarter. When should you invest? So if not individual stocks, and keep buying is the mantra, when exactly should you buy? Did you know that the stock market rises far more often than it falls? In fact, throughout the 20th century, the Dow Jones Industrial Average rose from just 66 points to over 11,497 points. And this growth didn't happen during peaceful times. It happened while the world was going through major world wars, the Great Depression, more than 10 economic recessions, oil crises, and even a U.S. president's resignation during his term. This pattern isn't limited to just the U.S. market either. As we saw earlier, global markets also showed positive long-term trends over the decades, despite the many challenges they faced. If the odds are so clearly in your favor, why wait? Every day you postpone investing is a lost opportunity for your money to grow. The earlier you start, the more time you give your investments to compound and multiply. So don't wait for the perfect moment. Start now. Imagine you suddenly have $1 million, and your goal is to grow it steadily over the next 100 years. You have two options. Invest the entire $1 million today, or invest 1% of it, $10,000 every year for 100 years. Which strategy seems better in terms of long-term growth? A simple thought experiment reveals a powerful truth that most people miss. The better option is to invest the entire $1 million at the start. Why? Because the earlier you invest, the more time you give your money to grow. If you spread the investment over hundreds of years, stock prices might rise, but the remaining uninvested money will still be vulnerable to losing its value due to inflation. Of course, putting all your money into the stock market at once might seem risky, but you can significantly reduce this risk by building a diversified portfolio, perhaps 60% in stocks and 40% in bonds. This way, you empower your money to grow while simultaneously protecting yourself from significant losses. In fact, a 40-60 portfolio can outperform a strategy of investing $10,000 annually in stocks. Perhaps you don't have $1 million now, and that's perfectly normal. What matters here are these points. The stock market tends to rise over time. The best time to invest is not Sunday, It's now. By investing early, you give your money more time to grow and protect it from the slow poison of inflation. Most importantly, you take real steps towards building a secure and comfortable retirement. So don't wait for conditions to align perfectly. Keep buying. Start today. Why shouldn't you be afraid of volatility? But let's be honest. The market can be terrifying. Those massive drops. How do you overcome that fear? Here's an investment tip that might surprise you. The biggest risk is not taking any risks at all. If you fear stock price drops and avoid investing because of this fear, you will miss out on one of the greatest opportunities to grow your money. To achieve success as a long-term investor, you must learn to accept volatility, market instability, and the temporary crashes that naturally occur. Let's consider a thought experiment. Imagine a magic genie appears to you at the end of each year and tells you the maximum decline that might occur in the U.S. stock market during the following year. But this genie cannot tell you which individual stocks to pick or how the market will perform overall. He can only tell you the largest internal drawdown of the year. That is, the largest drop from the highest point to the lowest point within the year. The question here is, at what point would you decide to exit stocks and move into bonds? What if the genie told you the market might drop by 40% next year? Would you invest? And what about a 20% drop? What is your personal limit that you won't cross? Before you answer, here's some information that might help you. From 1950 to 2020, the average maximum annual drawdown for the S&P 500 was about 13.7%. The worst annual decline happened in November 2008, when the index fell by approximately 48%. Let's look at some scenarios. Scenario 1. Let's assume you are a very conservative investor. You tell the genie that you will not invest in stocks in any year where the market is expected to drop by 5% or more. By avoiding risk, you would have missed most of the stock market's growth. The results from this experiment are shocking, and they'll completely change your perspective on risk. Scenario 2. Now, let's assume you avoid investing only in years where the market is expected to drop by 40% or more. In this case, you would have exited the market only in 2008. This might have led to a slight outperformance over the buy and hold strategy, but the difference would be very minimal. Scenario 3. The balanced strategy. Here, you try to avoid investing in stocks only in years where the market is expected to drop by 15% or more. In this case, you would move to bonds during highly volatile years and remain invested in stocks in other years. This method provides a good balance between risk reduction and long-term growth. According to this strategy, you would find yourself out of the stock market only about 1/3 of the time. That is during years of high volatility. But if you narrowed your tolerance to include drops of 20% or 30%, you might find yourself staying in the market during its worst periods and losing money instead of making gains. How do you buy during a crisis? Speaking of market drops, what about the really big ones? Like a global pandemic? The COVID-19 pandemic shook the entire world, and financial markets were no exception. On March 23, 2020, the S&P 500 dropped by 33% from its peak. If you were an investor at that time, what would you have done? Would you have panicked and sold your stocks? Or would you have remained calm in the face of business closures and overwhelming uncertainty? A famous quote from the British banker Baron Rothschild gives us something to ponder. The best time to invest is when there's blood in the streets. Rothschild built his fortune during the chaos of the Battle of Waterloo, when most investors were panicking. And this philosophy remains true even today. When prices are low and fear is high, the opportunity is greatest. If you buy when the market crashes, your investments can grow significantly as the market recovers. Consider this historical example. Let's assume you are investing $100 per month in the U.S. stock market from September 1929 to November 1936. This period includes the famous 1929 crash and the subsequent recovery. Data shows that every $100 you invested would have grown by November 1936. And here's the mathematical secret behind why these moments are actually your biggest opportunities. But the most powerful gains came from the money you invested during the low. Those investments of just $100 would have grown to $440 by late 1936. That's more than quadruple the original value. And this type of explosive growth during recovery isn't rare. In fact, most market crashes often lead to gains ranging between 50% and 100% in the recovery phase that follows. Why does this happen? It relies on a simple yet powerful mathematical truth. Recovering losses requires a larger percentage gain. For example, to recover a 10% loss, you need an 11.1% gain. To recover a 20% loss, you need a 25% gain. And to recover a 50% loss, you need a 100% gain to reach the break-even point. If you plot this relationship on a graph, you'll notice an exponential curve illustrating how large losses require larger and steeper gains to compensate for them. For example, on March 23, 2020, it achieved that within just 6 months. Investors who had the courage to buy stocks during the crash saw their money grow by 50% in half a year. Do you need more evidence? Let's look at data from every time the market dropped by 30% or more between 1920 and 2020. If you had invested during the months of declines, your chances of achieving an annual return of less than 5% were less than 10%. In more than half of the cases, you would have achieved annual returns exceeding 10%. If you've ever doubted buying during a crash, this next statistic will silence your fears. And now for the surprise. If the market fell by 50% and you invested at that moment, your chances of achieving annual returns exceeding 25% were greater than 50%. In other words, there's no need to fear market crashes. They often offer the best opportunities to invest and grow your wealth. Historically, markets tend to fully recover within a few years, or at most a decade. Still not convinced? A study covering 39 countries from 1814 to 2019 found that the likelihood of inflation outperforming long-term stock market returns was only 12%. This means there's only a 1 in 8 chance that inflation will outperform your investment returns over a 30-year period. When should you sell? All right, you've been buying, you've navigated the storms, but eventually you'll need to sell. And this is where emotions can derail everything. Why? Because your emotions will pressure you to hold on a little longer, hoping for more returns, or they'll drive you to sell immediately to avoid potential losses. To avoid falling into this emotional trap, you need to be clear about one thing. Do not sell emotionally. Instead, sell for a specific reason, either to rebalance your portfolio, to exit a concentrated investment, or to meet an external financial need. Outside of these three reasons, avoid selling solely to avoid taxes or to chase market timing. Before we detail these cases, let's remember something important. Sell at the right time, not quickly. As we discussed earlier, the market tends to rise more than it falls. Even if you decide to sell years later, it's likely that your investments will have grown. But if you sell too early, you might miss the next big upward trend. Therefore, the smart decision is to buy now and sell gradually, in a way that enhances your long-term wealth. Scenario 1. Selling to rebalance. When you start investing, you usually set a target asset allocation. For example, 60% in U.S. stocks and 40% in U.S. bonds. If you have $1,000, this means $600 in stocks and $400 in bonds. But over time, higher return assets like stocks will start to dominate your portfolio. If you don't rebalance, your asset mix might drift away from your original plan. For example, if you invested $1,000 in 1930 and didn't touch it for 30 years, by 1960, your portfolio would have shifted from a 60-40 ratio to between 75% and 95% stocks. Whereas if you had rebalanced annually, your allocation ratio would still be close to 60% stocks and 40% bonds. For this reason, stocks outperform bonds long term, and rebalancing allows you to lock in some profits by shifting a portion of gains into safer assets. Yes, not rebalancing might lead to slightly better performance due to higher stock exposure. But smart investors rebalance to control risk. The goal of rebalancing isn't to maximize returns. It's to protect yourself from unwanted volatility. Without rebalancing, your portfolio might transform, becoming something far riskier than you initially planned. Rebalancing annually is usually the most practical approach. You'll only need to do it once a year, which means less monitoring, and greater peace of mind. Trying to rebalance whenever the stock percentage reaches 70% or drops to 50% can be exhausting and inefficient. You can also rebalance during tax season by selling profits and managing capital gains taxes all at once. This approach saves time and effort, but frequent rebalancing can lead to higher taxes and might reduce your long-term wealth. Another approach. The author suggests another way to rebalance without selling. Instead of selling your winning assets, buy more of the assets that have lagged. For example, if your portfolio becomes 70% stocks and 30% bonds, you can correct the imbalance not by selling stocks, but by buying more bonds until the ratio returns to 60-40. This way, you avoid capital gains taxes and continue to invest regularly. This approach is very useful during market downturns, when buying can lead to better results. However, this approach works best for investors who are still in the accumulation phase. If your portfolios have already grown significantly, continuing to buy might not be a practical option. In these cases, selling to rebalance might be necessary, but try to minimize sales to avoid unnecessary tax costs. Scenario 2. Exiting a concentrated investment. This means a significant portion of your wealth is tied to a single asset or stock. For example, if you work for a company that offers stock-based compensation, you might find that a large portion of your net worth is tied to this single stock. And this isn't necessarily a bad thing until it becomes one. As your investment grows, it's wise to start selling small portions to reduce risk. The amount you sell depends on your goals. Let's say you have a mortgage, and a large portion of your wealth is in the stock of the company you work for. You can sell a portion to pay off the mortgage. Yes, these stocks might grow faster than your home's value, but this growth is just a possibility. The mortgage, however, is a guaranteed obligation. You can sell 10% monthly or divest 50% at once and keep the rest. This depends on you. But the firm rule is, do not sell everything at once. A large sale can lead to significant tax consequences, and you might regret it if the stock price rises later. Remember, individual stocks often fail to outperform indices like the S&P 500 over the long term. So ask yourself, what level of risk are you comfortable with? Based on that, plan your own selling strategies. Scenario 3. Using your money to enjoy your life. Whether it's to fund a comfortable retirement, take a summer vacation, pay for your children's education, or cover your family's health care, using your money is not a bad thing. The author highlights a concept called diminishing marginal utility. This means that the more you have of something, the less value each additional unit brings. For example, increasing your wealth from $0 to $1 million brings far greater happiness than increasing your wealth from $1 million to $2 million. Once you secure your family's needs, luxurious additions don't add much joy. But providing meaningful experiences for your loved ones. Yes, selling isn't a failure. It's part of the game. Because the ultimate goal of investing isn't just about accumulating wealth. It's about truly living. The real goal of investing isn't just to increase your net worth. It's to create the life you've always dreamed of. Conclusion. In our journey through the philosophy of keep buying, we've learned a set of valuable lessons that can form the foundation for achieving long-term financial success. Let's quickly review the main points we covered. First, why investing is so important. It's essential for saving money for retirement, for protecting your money from inflation, and for converting your human capital, your time, skills, and effort into financial capital that works for you, even when you can't work yourself. Second, different types of assets. We explored stocks, bonds, real estate, and REITs. Each of these asset classes has its own benefits and risks. Therefore, it's essential to build a diversified portfolio that not only grows your wealth, but also helps you manage risks effectively. Why you shouldn't buy individual stocks. Picking winning stocks is incredibly difficult, even for professional investors. Instead of chasing performance, invest in index funds or low-cost index funds, and let the market work for you. Fourth, the importance of starting as early as possible. Every day you postpone investing is a lost opportunity for your money to grow. If you want to beat inflation and build wealth, the best time to invest is now. Fifth, no need to fear market volatility. Trying to time the market or avoid it during downturns only leads to missing valuable opportunities. Instead, focus on building a diversified portfolio and continue long-term investing. Sixth, the power of continuing to buy during crises. Yes, crashes can be scary, but most markets recover within a few years, and sometimes even faster. And since every percentage of loss requires a larger percentage of growth to recover, buying during crashes often leads to the highest rewards. In other words, crisis creates opportunities. Seventh, when selling makes sense. Don't let your emotions drive your decisions. Instead, sell to rebalance your portfolio, to exit a concentrated investment, or to meet important financial needs. Selling at the right time and for the right reasons helps you stay on track while minimizing unnecessary stress and taxes. Every day, we face financial decisions, and we always live in a state of uncertainty about the future. We don't have a magic lamp or a time machine, but we do have timeless principles you've just heard in this summary. If you follow these simple guidelines, you will be on the right path towards long-term financial success. Yes, you can become rich, but everything starts with one decision. Start investing as soon as possible. So no matter where you're starting from, and no matter what's happening in the world, keep buying.